If your stock disappeared from the stock exchange tomorrow, would you still feel good about owning it? Heyo, book lovers. It's me, Zuzu, your favorite vlogging monkey from Zuzu the Book Reader. Today, we're diving into a true investing Bible, The Intelligent Investor by Benjamin Graham, with contributions from Jason Zweig and a legendary preface by Warren Buffett himself. So, what's in it for you? Why should you spend your next 20 minutes with this summary? Learn the real difference between investing and speculation. Hint: most people don't actually invest. Discover how to protect your money from market swings using the margin of safety. Meet the two kinds of investors, defensive and enterprising, and find out which one you are. Avoid the traps of Wall Street hype and survive financial storms like a pro. Understand why being consistently not stupid beats being brilliant occasionally in investing. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. Benjamin Graham kicks off this financial masterclass by drawing a bold line between investing and speculating. Most people in the market think they're investors, but Graham argues, nah, they're just gambling with fancier words. An investment, according to Graham, is something that, after thorough analysis, promises both the safety of your principal and an adequate return. Anything that doesn't meet both standards, that's speculation. And most people, especially during market booms, are speculators in disguise. Graham warns us that Wall Street has blurred the lines. Headlines often call everyone an investor, even those short selling on emotion or chasing hot tips. He finds this misuse of the term deeply concerning. A real investor does research, protects their downside, and doesn't rely on hype or hope. He points out that over time, public perception has shifted. After the 1929 crash, stocks were seen as gambling tools. But by the 1960s and 70s, even reckless stock buyers were being called investors, simply because the market had gone up. That shift, Graham argues, is dangerous. The chapter also explains why the intelligent investor must expect some level of speculation in common stocks. The key is to keep it controlled. Graham believes it's okay to speculate, but only with a small portion of your capital and in a separate mental and physical account from your core investments. Keep the fun money and the serious money apart. There's also a brilliant warning. Speculating without realizing you're speculating is the most dangerous trap of all. You might get lucky for a while, but long-term wealth requires discipline, knowledge, and patience, not hot tips or guessing games. Graham offers strategies for the two major investor types. Defensive investors, low-effort, safety-focused folks, should avoid speculation and focus on solid, diversified, long-term holdings. Enterprising investors, active, research-driven individuals, may take calculated risks, but only if they truly understand what they're doing. He also discusses 3 dangerous forms of unintelligent speculation. Thinking you're investing when you're actually speculating. Taking speculation too seriously without the required knowledge. Betting more money than you can afford to lose. Bottom line: speculation isn't a sin, but confusing it with investing is. Intelligent investors play the long game, guided by logic, research, and a rock-solid foundation of financial principles. Let me leave you with a curious thought. When you look at your investment portfolio, are you holding solid businesses you'd own forever, or just dice you're rolling for quick wins? Chapter 2. The Investor and Inflation. Inflation sounds like an economic word your uncle throws around, right? But here's the truth. Inflation is like a silent termite, slowly chewing away at the buying power of your money. You think you're growing your wealth, but if you ignore inflation, you might be going backward. Graham begins by describing how inflation impacts investors with fixed dollar assets like bonds. When prices rise but your income stays flat, you're actually losing value. For example, earning 3% interest in a year where inflation is 4% means you're really losing 1%. It's called the money illusion. We feel richer seeing a bigger number even when it buys us less. Now here comes the classic Graham advice: diversification. Don't go all in on stocks because of inflation fears, and don't flee to bonds because of market panic. The wise investor holds both, adjusting the mix depending on market conditions and personal goals. What about gold, real estate, or collectibles as inflation hedges? Graham says, be careful. These might look attractive, but they come with risks like storage, high fees, or poor diversification. And gold? It didn't even outperform savings accounts for decades. So how should you prepare for inflation? Keep a balanced portfolio, stay grounded in value, and avoid panic or blind faith in any one safe asset. And most of all, measure success not by what you make, but by what you keep after inflation. That's what makes an investor intelligent. Think about it. If your money had a voice, what would it say about how well you're protecting its value in the long run? He warns us not to fall for the idea that stocks are a guaranteed hedge against inflation. Yes, in theory, companies can raise prices and pass on costs to consumers. But history shows it's not that simple. From 1966 to 1970, prices rose 22%, but earnings and stock prices actually fell. There's no reliable link between rising prices and stock returns. So, assuming stocks will always beat inflation? Not so smart. Graham takes a closer look at corporate earnings and capital returns and finds something surprising. Despite decades of inflation, businesses didn't actually earn more in real terms. In fact, they often just borrowed more money to appear profitable. Between 1950 and 1969, corporate debt grew almost fivefold, while profits merely doubled. So, companies weren't getting richer. They were just using more debt to stay afloat. Chapter 3. A Century of Stock Market History. The Level of Stock Prices in Early 1972. Benjamin Graham opens this chapter with a crucial point. If you're going to invest in the stock market, you must understand its history, not to predict the future, but to make informed, realistic decisions. The past century of the stock market, from 1871 to 1971, has been filled with booms, busts, and everything in between. Graham presents a detailed timeline of bull and bear market cycles, using the Dow Jones Industrial Average and the Standard & Poor's Composite Index as references. He explains how the market tends to swing wildly from optimism to despair and back, and how the smart investor never forgets that every boom has a bust lurking behind it. The chapter highlights that between 1949 and 1968, the market enjoyed its greatest bull run ever, with prices rising sixfold. This created a wave of investor confidence that, Graham warns, could become dangerous overconfidence. People assumed this incredible growth would go on forever. Spoiler, it didn't. So what should an intelligent investor take from a century of data? That markets always fluctuate, but principles like value, discipline, and patience, those are timeless. Here's something to think about. If history repeats itself, how would you prepare your investments to survive both the sunshine and the storms? He then turns his sharp eye to the price earnings, P/E ratios, dividend yields, and bond interest rates in early 1972. At that time, stocks were earning less and yielding less than bonds, a warning sign for cautious investors. While the public still believed in the power of stocks, Graham suggests the valuation of the market was not attractive from a conservative investment standpoint. Even more striking is his observation of investor behavior. After market crashes in 1969 to 70, people quickly forgot the pain once prices recovered. Graham finds this lack of memory concerning and predicts that trouble could easily return. His advice? Investors must stay emotionally grounded. Use history to avoid being swept up by euphoria or panic. The market doesn't owe you a profit just because it did well yesterday. And don't get hypnotized by rosy predictions that ignore the painful lessons of the past. Chapter 4, General Portfolio Policy, the Defensive Investor. Benjamin Graham opens this chapter with a timeless reminder. Your portfolio should reflect who you are. Some people have time, skills, and energy to dig into research. They're the enterprising types. But others want safety, simplicity, and peace of mind. That's the defensive investor. And this chapter is written just for them. So what makes a portfolio defensive? Graham says it begins with choosing two things: high-grade bonds and high-grade common stocks. These aren't speculative picks. They're the financial equivalents of reliable, slow-moving turtles. Here's the golden rule: your portfolio should never have less than 25% or more than 75% in stocks, and vice versa for bonds. For most people, the default balance is 50-50. Why? Because it's easy to understand and maintain. When the stock portion rises to 55%, you sell a bit and move it into bonds. When it falls to 45%, you buy more stocks. That simple rebalancing forces you to buy low and sell high, without guessing the market. Here's a question for you to ponder. If you had to walk away from your investments for 5 years, would your portfolio be safe enough to grow while you're gone? But here's the kicker. Most people don't do it. When stocks go up, they pile in even more. When markets crash, they flee. Graham calls this emotional whiplash the root of bull and bear markets. His solution? Stick to your formula, not your feelings. He also walks us through what types of bonds to choose. The two big questions: should they be taxable or tax-free? And should they have long or short maturities? For many individuals, U.S. savings bonds offer unmatched safety and benefits. But if you've got more capital, municipal bonds might make sense, especially if you're in a high tax bracket. The key is to match your bond picks to your goals and your tax profile. What about stocks? Graham recommends well-established dividend-paying companies, and he'll go deeper into those in the next chapters. Bottom line, the defensive investor doesn't chase trends. They follow structure. They don't try to beat the market. They try to avoid being beaten by it. Chapter 5. The Defensive Investor and Common Stocks. Benjamin Graham begins by emphasizing the importance of owning common stocks, even for cautious investors. Why? Because over the long run, stocks have offered better protection against inflation and have provided higher average returns than bonds. But he gives a big warning. Don't overpay for them. Even great stocks become poor investments when bought at inflated prices, just like in 1929. Graham outlines a smart, conservative approach for defensive investors. He insists on a diversified portfolio of large, prominent, financially sound companies, especially those that have paid dividends consistently for 20 years or more. This gives stability, trustworthiness, and long-term performance. Here are the 4 rules for the defensive investor's stock selections. Diversify wisely. Don't put all your eggs in one basket. Graham suggests 10 to 30 different stocks, which reduces risk while keeping things manageable. Stick with large, stable companies. These are firms with strong reputations, long histories, and conservative financials. They're not exciting, but they're reliable. Look for a long dividend record. Graham recommends companies that have paid uninterrupted dividends for at least 20 years. Why? Because it shows consistency and financial discipline. Don't overpay. He sets a firm limit. Don't pay more than 25 times the average earnings over the past 7 years, or 20 times the most recent year's earnings. That rules out many hyped growth stocks. But Graham's not here to chase trends. He's here to build wealth wisely. Graham is especially skeptical of growth stocks, the darlings of Wall Street that promise sky-high returns. While some do become big winners, many others crash hard, taking investor money with them. His advice: unless you're doing serious research, avoid them. He also recommends a technique called dollar-cost averaging, investing a fixed amount regularly over time. This strategy automatically helps you buy more when prices are low and less when they're high, smoothing out the ups and downs. In the end, this chapter offers a simple truth. You don't have to be brilliant to succeed, just disciplined and consistent. Here's something to reflect on. If your future wealth depended only on being patient, steady, and cautious, would you still feel the need to chase the next hot stock? Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Benjamin Graham starts this chapter with a solid reminder. Whether you're a cautious or aggressive investor, your foundation should be the same. A balanced mix of high-grade bonds and top-quality common stocks bought at reasonable prices. That's your base camp. But if you're more hands-on, the enterprising path opens up, and so does the risk. Instead of jumping into flashy strategies, Graham begins with warnings. He lists what not to do, helping you avoid costly mistakes before thinking about big wins. And oh boy, there are a few traps the enterprising investor must sidestep. Avoid high-grade preferred stocks. These are often poor performers in tough markets and better suited for corporate portfolios that need tax advantages. Don't touch low-grade bonds and preferreds unless they're a true bargain. Graham insists on at least a 30% discount to par value for any hope of reward. Otherwise, the risk-to-reward ratio just doesn't make sense. Ask yourself this: before chasing a high-yield or hot stock, have you honestly weighed the risks, or are you just dazzled by potential rewards? Steer clear of foreign government bonds. Despite attractive yields, the risk of default, political instability, and lack of enforceability make them too dangerous for individual investors. Watch out for new issues, especially IPOs. Graham says IPOs often appear during market highs when sellers, not buyers, benefit most. Behind the marketing shine is usually a lack of a track record and inflated valuations. In other words, just because something is available doesn't mean it's valuable. Graham warns that Wall Street's salesmanship, especially during booming markets, can trick even smart investors into buying overpriced or risky securities. This chapter is a masterclass in skepticism. Graham doesn't say enterprising investors shouldn't take risks. He says they should take informed, rational risks. Just like a good chess player avoids blunders before thinking about bold moves. And here's his subtle wisdom. Sometimes the most profitable move is the one you don't make. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. Benjamin Graham now shifts gears. After warning us what not to do in Chapter 6, he now focuses on what an enterprising investor should do. This chapter is a goldmine of strategies for those who are ready to dig deeper, work harder, and think smarter. He opens by emphasizing that enterprising investors want better than average returns and are willing to put in the research and discipline to achieve them. These investors aren't just dabbling, they treat investing as a serious business. And just like any business, success comes from sound principles and disciplined execution. Graham outlines 4 main strategies that have historically worked for serious investors. Buy low, sell high, simple in theory, but emotionally difficult in practice. It requires buying when everyone else is scared and selling when everyone is euphoric. Buying carefully chosen growth stocks, companies with superior long-term growth. But Graham warns that these stocks are often overpriced due to market hype. The challenge is not just identifying good businesses, but buying them at reasonable prices. Buying bargain issues, undervalued stocks trading well below their intrinsic worth. This is Graham's bread and butter, classic value investing. Think neglected, unpopular companies that are still financially strong. Buying into special situations, mergers, spin-offs, restructurings, bankruptcies, events that can unlock hidden value. These require deep knowledge and analysis, but can offer high returns when done right. He provides compelling evidence supporting the value strategy. Studies show that cheap stocks with low price-to-earnings ratios have significantly outperformed expensive growth stocks over decades. For example, buying the lowest priced Dow Jones stocks regularly would have trounced the results of buying the most popular ones. Graham also advises seeking unpopular but high-quality large companies, those going through rough patches. They often rebound, and investors who bought during their downturns saw strong returns. These companies have the resources and stability to bounce back, unlike many small firms that might never recover. One key insight: even if a smaller company looks promising, it should only be bought if its price is well below its true value. Otherwise, you're gambling, not investing. Here's your banana for thought. If you were picking stocks like fruit, would you go for the shiny ones everyone is grabbing, or the slightly bruised ones that are still full of value on the inside? Chapter 8: The Investor and Market Fluctuations. Benjamin Graham begins this chapter with a powerful truth. Markets move up and down, and investors must be prepared both financially and emotionally for these fluctuations. Price changes are a normal part of investing, not a sign of failure. He introduces a brilliant character, Mr. Market, your unpredictable business partner. Every day, Mr. Market comes to your door offering to buy your stocks or sell you his, based on his mood. Some days he's euphoric and offers outrageous prices. Other days he's depressed and offers next to nothing. But here's the catch: you don't have to engage with him. You can take his offer if it suits you, or just ignore him. This metaphor teaches a powerful lesson. You, the investor, are in control. The market doesn't tell you what something is worth. You decide based on facts, fundamentals, and long-term thinking. Graham explains two approaches investors use to handle market swings. His final advice: think long-term. Ignore day-to-day noise. Don't judge success by whether you beat the market. Judge it by whether you meet your goals, with calm, discipline, and clarity. Imagine this: if your favorite fruit stand changed its prices wildly every day, would you let that confuse you? Or would you simply buy more when the fruit is cheap and delicious? Market timing, trying to predict when prices will go up or down to buy-sell at perfect times. Graham says, avoid it. It's nearly impossible and turns you into a speculator. Pricing, buying when stocks are undervalued and selling when they're overpriced. This is the intelligent way. It takes patience and discipline, but history shows it works. He emphasizes that volatility is your friend, if you stay rational. When prices plunge, buy great businesses on sale. When prices soar, consider trimming. But don't get emotional. Don't chase rising prices out of greed or sell in panic during a drop. Graham also says your investment results depend more on your behavior than on market performance. Buying after prices rise or selling after they fall. That's backward. True investors welcome bear markets. They offer the best opportunities to buy low. Chapter 9: Investing in Investment Funds. Benjamin Graham starts with a question many investors ask. Should I just put my money in a mutual fund? For the defensive investor, the answer could be yes, but only if done wisely. He introduces us to two main types of funds: open-end funds, mutual funds. These are redeemable at any time for the value of the assets they hold. They're constantly adding new investors. Closed-end funds. These have a fixed number of shares, which trade on the stock exchange like regular stocks, sometimes at a discount or premium to their asset value. Graham notes that mutual funds can help investors avoid costly errors. They promote good saving habits, protect against reckless speculation, and help match market performance. But, and this is crucial, many don't actually beat the market. Why? High fees, overtrading, and misaligned incentives. One standout takeaway: fund investing isn't about beating the pros. It's about not losing to your own bad behavior. Stay rational, avoid jumping between funds, and remember, most of the work of good investing is controlling your impulses, not chasing excitement. So here's something to reflect on. If your goal is slow and steady financial growth, Are your fund choices aligned with that? Or are they driven by the thrill of short-term returns? He explains how performance funds, especially popular in the 1960s, dazzled investors with huge short-term gains, but those managers often took excessive risks. When the bull market faded, so did their results, often with devastating losses. So, can you pick a fund that beats the market? Graham is skeptical. He says that the average mutual fund doesn't outperform the general market, especially after fees. Your best bet is to avoid chasing past winners and instead focus on cost, strategy, and discipline. His smart tips for fund investing: avoid funds with high sales charges, load funds, prefer low-cost, no-load funds, look for consistency, not hype. Consider closed-end funds at a discount, since you may get more value for your dollar compared to open-end funds sold at a premium. Don't be seduced by hot sector funds. They usually cool off fast. Be cautious with balanced funds, since you might be better off managing your own mix of bonds and stocks directly. Chapter 10. The Investor and His Advisors. Benjamin Graham opens this chapter with a hard truth. Most investors rely on advice, but not all advice is created equal. The financial world is crowded with voices, from brokers and bankers to friends and TV experts. The real challenge is deciding whom to trust and how to use their input wisely. Graham reminds us that investing is not like hiring a doctor. You're not just handing over your money and expecting a miracle cure. In fact, expecting your advisor to make you rich is as unrealistic as asking someone to run your business for you while you relax. Instead, a great advisor helps you avoid mistakes, stay disciplined, and meet realistic goals, not chase fantasies. He breaks down the types of advisors investors commonly turn to: friends or relatives, often well-meaning but rarely objective or informed; local bankers, conservative and steady, useful for cautious investors; brokerage firms and salesmen, sometimes too focused on selling products rather than offering personalized guidance; financial services and newsletters, useful for broad market insights but not tailored to your specific needs; professional investment counselors. These are the most reliable, but only if they have strong reputations and modest promises. Graham stresses that even professional advisors are not magicians. The best ones manage risk, stick to fundamentals, and help you stay the course. Their job isn't to beat the market, but to help you avoid self-sabotage, which, let's face it, is the biggest threat to any investor. He also warns that unethical advisors exist, especially those who mix sales with advice. That's why Graham insists you should never blindly follow recommendations. If you're a defensive investor, make sure your advisor knows you want safe, high-grade bonds and solid blue-chip stocks. And if you're enterprising, ask tough questions and insist on clarity before making any moves. In short, the advisor you choose must earn your trust. And even then, your job isn't done. Stay involved, stay informed, and remember, no one cares about your money more than you do. Think about this. If you're trusting someone with your financial future, have you asked them the same tough questions you'd ask someone you were hiring for your dream business? Chapter 11. Security Analysis for the Lay Investor. General Approach. Benjamin Graham begins by explaining that security analysis is the process of examining the past, present, and future of a stock or bond to decide if it's a sound investment. While professionals may use fancy math or complex models, Graham urges everyday investors to focus on what actually matters and keep things simple. He says security analysts should describe the business, summarize past performance, estimate future earnings, evaluate risks and opportunities, compare companies over time or with peers, judge safety for bonds or attractiveness for stocks. For lay investors, Graham warns against getting too fancy with predictions. He jokes that if an analyst starts using calculus or higher algebra, you should probably run. He prefers basic arithmetic and plain reasoning because forecasting the future is already tricky, so don't overcomplicate it with illusions of precision. Graham divides the chapter into two parts: one for bond analysis and one for stock analysis. For bonds and preferred stocks, the main test is interest coverage. How many times a company's earnings cover its interest payments? A higher coverage means the company can more safely meet its obligations, even during downturns. He gives different benchmarks depending on industry type. For example, industrial companies should have at least 7 times coverage on average, or 5 times in the worst year. When it comes to common stocks, Graham admits analysts have historically been less rigorous. Too often, they rely on short-term projections or gut feeling. But he encourages a 2-step process. Past performance value. Use history to estimate what the stock would be worth if past results continued. Adjustment for future potential. Modify the value based on expected changes, but be careful as the future is foggy. He warns that many so-called growth. Ultimately, Graham champions a pragmatic approach. Use simple, consistent methods based on earnings, dividend history, and financial strength, and apply them to a group of stocks, not just one. Group estimates tend to be more reliable than predictions about individual companies. Here's something to chew on. When you're judging a company, are you dazzled by future promises or grounded in what its numbers actually say? Okay valuations rely too much on hoped-for future profits, which can lead to big miscalculations if those hopes don't materialize. Chapter 12. Things to consider about per-share earnings. Benjamin Graham opens this chapter with a double-edged message. First, he says, don't take a single year's earnings too seriously. But second, knowing that most people will look at short-term earnings anyway, he warns, be careful. Per-share figures can be full of traps. Companies often report multiple versions of their earnings per share, EPS, primary earnings, fully diluted earnings, before special charges, after special charges, and each number tells a different story. Graham uses Aluminum Company of America ALCOA as an example. On the surface, it looked like ALCOA earned $5.20 per share in 1970. But once you accounted for footnotes and special charges, the true earnings could be as low as $2.80. That's a huge swing, and it dramatically changes how cheap or expensive the stock looks. He shows that investors can be easily misled if they rely on surface-level numbers. For example, ignoring special charges, like costs from closing a plant or writing off an acquisition, can make a company's performance look better than it really is. Companies sometimes take huge losses in one year to clean up their books and make future years look great, even if those losses were spread out over time in reality. Another big concern is dilution. When companies issue new shares or have convertible bonds and stock options outstanding, these can drastically reduce the real earnings available to each shareholder. But investors don't always notice this in reported earnings, especially if the dilution effect is hidden in the footnotes. Graham also criticizes how analysts focus on quarterly results and short-term trends. He encourages using average earnings over 7 to 10 years to smooth out ups and downs and get a clearer picture of a company's long-term performance. This helps filter out the noise from accounting gimmicks, one-time events, or tax strategies. His message is clear. Don't trust EPS at face value. Dig into the footnotes. Look at averages. Be skeptical. Per-share earnings can be useful, but only when you know what's behind the numbers. Imagine this. If a company told you, I made a lot of money last year, would you take it at face value? Or would you ask, how exactly did you make that money? Chapter 13, a comparison of 4 listed companies. In this practical and eye-opening chapter, Graham picks 4 companies: Eltra Corporation, Emerson Electric, Emory Air Freight, and Emhart Corporation, to compare using real-world financial data. His goal? To demonstrate how investors can use straightforward analysis to identify true value and avoid being seduced by hype. Graham compares the companies across 6 key dimensions: profitability, stability, growth, financial condition, dividends, and price history. Here's the quick rundown. Profitability. All four companies were profitable, but Emerson and Emery had exceptionally high returns on book value, suggesting strong earnings power. Emerson stood out with its impressive return on invested capital, which often signals sustainable growth. Stability. Graham looks at how much a company's earnings fell during the worst year. Emerson and Emery had perfect stability, no declines, while Eltra and Emhart experienced only moderate drops, better than the market average at the time. Growth. Emery led the pack with explosive earnings growth, while Eltra and Emhart also showed strong performance, especially considering their low market valuations. This is where Graham begins hinting at something important. Great value might be hiding in boring companies. Financial position. Eltra, Emerson, and Emhart had solid balance sheets with more than $2 in assets for every dollar in liabilities. Emery's numbers weren't as strong, but its business model justified the difference. Dividends. Emhart took the crown here with an uninterrupted record of dividends since 1902. All four paid dividends, but the yield was significantly higher for the lower-priced companies. Price and valuation. This is the big reveal. Despite Emerson and Emery's better market performance and popularity, Eltra and Emhart offered far better value. Their price-to-earnings and price-to-book ratios were much lower, meaning investors could buy more underlying business for every dollar spent. Graham's conclusion? While Emerson and Emery may look more exciting, Eltra and Emhart represent better value investments. They meet all of Graham's criteria for a conservative investor: solid earnings, good balance sheets, long-term dividend history, and reasonable prices. So here's your investor reflection. Would you rather buy a flashy company at 40 times earnings, or a solid, steady one at 10 times earnings and twice the dividend? Chapter 14. Stock Selection for the Defensive Investor. Benjamin Graham opens this chapter by answering a question millions of cautious investors ask: what stocks should I buy if I want safety, simplicity, and decent returns? His answer? Build a portfolio using either a simple cross-section of top U.S. companies, like the Dow Jones Industrial Average, or a carefully screened list based on strict, proven criteria. For the first method, Graham suggests buying equal shares of every stock in the DJIA. This offers instant diversification and exposure to some of the country's strongest businesses without needing deep analysis. But for those who prefer the second route, selecting individual stocks based on logic, not luck, he lays out 7 specific rules. Adequate size. Stick to large companies. At least $100 million in annual sales for industrial firms and $50 million in total assets for utilities. Big businesses are generally more stable. These rules are designed to ensure you're buying high-quality companies at fair prices, avoiding overpriced popular stocks while staying safe from risky speculative picks. Graham's message is simple. Defensive investing is about discipline, not prediction. Follow a few time-tested rules, diversify wisely, and resist the urge to chase hot tips or market trends. So here's something to consider. When building your portfolio, are you choosing based on proven facts, or just a company name everyone's talking about? Strong financial condition. For industrials, current assets should be at least twice current liabilities, and long-term debt should be smaller than working capital. Utilities should have debt no more than twice stockholder equity. Earnings. Stability. The company must have positive earnings for at least 10 straight years. Dividend record. A consistent 20-year track record of paying dividends is a must. This proves reliability. Earnings growth. Earnings per share should have grown by at least 1/3 over the last 10 years, using average values from the beginning and end. Moderate price-earnings ratio. Don't pay more than 15 times average earnings from the past 3 years. Moderate price to assets. The price shouldn't exceed 1.5 times book value. Or, to be flexible, Graham says the product of the P/E ratio and price-book ratio should not exceed 22.5. Chapter 15. Stock Selection for the Enterprising Investor. Benjamin Graham opens this chapter with a refreshing honesty. Beating the market is very hard. Even professional fund managers with all their resources rarely outperform the general market over time. Still, he believes individual investors can succeed, but only with discipline, patience, and a proven strategy. The enterprising investor doesn't just settle for average returns. Instead of buying broad indexes or blue-chip stocks, they dig into lesser-known or neglected companies, ones the market may have overlooked or undervalued. But Graham warns, this isn't a game of guts or luck. It's a methodical hunt using strict rules. He outlines a screening process for selecting stocks with strong financial health and undervalued prices. Here are his key criteria: current assets greater than or equal to 1.5 times current liabilities, debt less than or equal to 110% of net current assets, no earnings deficit in the last 5 years, some current dividend paid, recent earnings higher than those in 1966, stock price less than 120% of net tangible assets. So here's the golden question. Are you willing to go beyond headlines and hype and patiently hunt for stocks the market has forgotten? Using this filter, Graham shows how you can reduce thousands of companies to a handful of strong candidates. In fact, by analyzing just the first 450 listings in the Standard & Poor's Stock Guide, he narrows the field to 15 qualifying stocks, forming a model portfolio of low-multiplier industrial stocks. He emphasizes that you don't need to predict the future. Just make rational decisions based on present value. The enterprising investor's edge is in spotting stocks that are unfairly undervalued, not based on excitement or hype, but on cold, hard numbers. Graham also discusses 2 simple strategies that consistently perform well. Buy low P/E stocks of established companies. Buy stocks priced below their net current assets, meaning you're paying less than the cash and inventory alone. These are classic value strategies. They're not exciting, but they work. Chapter 16. Convertible Issues and Warrants. Benjamin Graham begins by explaining convertible bonds, investments that start life as regular bonds, earning interest, but can be converted into a company's stock. They seem like a win-win, the safety of a bond with the upside of a stock. However, Graham is quick to challenge that optimism. He points out that this supposed win-win often comes with trade-offs. For the investor, you give up some yield and quality in exchange for potential future growth. For the company, you get lower financing costs, but give up some ownership and future gains to new shareholders. Graham warns that these securities tend to be issued at the tail end of bull markets, when companies can offer optimistic futures and investors let their guard down. Historically, convertibles issued at market peaks often deliver poor returns, especially when the underlying stock drops in value. He then walks through the risks. Dilution. If many bonds get converted, existing shareholders own a smaller piece of the pie. The final verdict? Don't be dazzled by complexity. Convertibles and warrants can be useful in rare cases, but more often, they mask risk and weaken transparency. Stick with what you understand, and don't assume every hybrid is an innovation. Sometimes it's just marketing in disguise. Now think about this. If someone handed you a shiny tool you didn't fully understand, would you use it to build your financial future, or toss it back and pick up something simpler and sturdier? Low-quality issues. Convertibles are often offered by companies that wouldn't qualify for standard bond financing. Investor confusion. Many don't understand the true risks and return profile of convertibles. They're not as safe as bonds and not as powerful as pure stocks. Then comes the real heat. Graham's take on warrants. Warrants are like long-term stock options. They allow you to buy shares in the future at a fixed price. Sounds clever? Graham calls them a menace, a near fraud, and financial mischief. Why? Because they create paper value out of thin air and mislead investors, often artificially inflating stock prices or underrepresenting real dilution risk. He gives examples of warrants issued during the 1929 boom that eventually became worthless, despite having market values in the billions. He urges investors to view warrants with deep skepticism and, if possible, to avoid them entirely. Chapter 17. 4 Extremely Instructive Case Histories. Graham handpicks 4 companies that teach us unforgettable lessons about what not to do in investing. These stories reveal how illusions, hype, debt, and bad management can destroy even the biggest-looking businesses. 1. Penn Central, the tottering giant. Once the largest railroad company in the U.S., Penn Central shocked the world by going bankrupt in 1970. But Graham shows that the signs were obvious: dangerously low interest coverage, less than 2 times, no real profits, and years of not paying income tax, a red flag that earnings were likely fabricated. Despite its massive size, basic financial analysis would have warned any investor to stay away. 2. Ling Temco Vought, the empire builder. Founded by a college student selling mobile homes, AAA jumped into franchising and tax prep services, then launched a hyped-up IPO. Despite shaky financials, the stock soared, only to collapse within 2 years. Graham exposes the IPO frenzy, showing how investors bought based on excitement, not fundamentals, a trap that still snags people today. Through all 4 stories, Graham drives home one message: it's not enough to believe the hype. You must look at debt, earnings quality, business logic, and management behavior. These disasters could have been avoided with basic analysis and skepticism. Think about this. Are you buying companies because of their stories, or because of what their numbers and business models actually tell you? This company exploded in size by acquiring dozens of other firms. Sales went from $7 million to $2.8 billion in 10 years, but so did debt. By 1970, it had $1.8 billion in liabilities and collapsed under its own weight. Graham criticizes the banks that lent money carelessly and warns investors: growth for the sake of growth is dangerous, especially when fueled by borrowed money. 3. NVF Corp., the tiny takeover machine. NVF, a small plastics company, bought Sharon Steel, a firm 7 times its size. To finance the deal, NVF issued junk-grade bonds and warrants. The result? A bloated, financially weak company with misleading earnings and massive debt. Graham calls it one of the most lopsided mergers in market history, and a lesson in how not to use financial engineering. 4. AAA Enterprises, the IPO mirage. Founded by a college student selling mobile homes, AAA jumped into franchising and tax prep services, then launched a hyped-up IPO. Despite shaky financials, the stock soared, only to collapse within 2 years. Graham exposes the IPO frenzy, showing how investors bought based on excitement, not fundamentals, a trap that still snags people today. Through all 4 stories, Graham drives home one message: it's not enough to believe the hype. You must look at debt, earnings quality, business logic, and management behavior. These disasters could have been avoided with basic analysis and skepticism. Think about this. Are you buying companies because of their stories, or because of what their numbers and business models actually tell you? Chapter 18. A comparison of 8 pairs of companies. In this hands-on chapter, Graham examines 8 pairs of companies that appear next to each other on the stock exchange list. He compares them across business models, growth rates, profitability, balance sheet strength, and, most importantly, market valuation. His goal? To reveal how irrational Wall Street can be, and how investors can spot mispriced gems. Pair 1. Real Estate Investment Trust versus Realty Equities Corporation. One is boring and stable with steady dividends since 1889. The other exploded with acquisitions and debt, dabbling in racetracks and movie theaters. Despite its reckless strategy, Wall Street rewarded realty with soaring prices until the collapse exposed its fragility. Pair 2. Air products and chemicals versus air reduction. Both operate in the same industry, but air products was growing faster and seemed more innovative. Yet Graham questions whether this justified its high valuation, especially when air reduction had stronger fundamentals and better dividend yield. Pair 3. American home products versus American hospital supply. Both were profitable, high-growth healthcare firms. But home products had far better margins and capital efficiency, yet sold for less than hospital, purely because the market was focused on growth hype. Pair 4. H&R Block versus Bluebell. Block's meteoric rise in the tax business wowed the market, while Bluebell, a steady earner in workwear, was overlooked. Block sold at 108x earnings, Bluebell at 11x, despite better earnings, dividends, and assets. Pair 5. International flavors and fragrances versus. International Harvester IFF was tiny but super profitable. Harvester was a giant with weak returns. IFF sold at 55x earnings, Harvester at 10x. Graham highlights how Wall Street chases profits and growth, not business size. Pair 6 to 8. Similar patterns continue. From overhyped conglomerates like National General to solid, undervalued industrials like National Presto, Graham shows again and again how the market can misprice risk, ignore value, and reward spectacle over substance. His lesson: just because a stock is popular doesn't mean it's a good buy, and just because a company is dull doesn't mean it's a poor investment. Think about this. If you had to choose between a flashy newcomer and a solid veteran, both sitting side by side on the stock list, would you know which one is the real intelligent investment? Chapter 19. Shareholders and Managements. Dividend Policy. Graham opens the chapter by pointing out a truth many investors ignore. Public shareholders rarely influence company management, even though they're the actual owners. For decades, Graham urged investors to demand transparency, performance, and fairness, but few listened. Shareholders rarely act, even when results are poor, management is weak, or stock prices fall. So what finally shook things up? Takeovers. When companies underperform, they often become targets for aggressive outsiders looking to replace incompetent managers. This fear has nudged boards and CEOs into being more responsive, not because shareholders spoke up, but because someone threatened their jobs. Then Graham dives into the heart of the chapter: dividend policy. Graham also discusses stock dividends and splits, explaining that they're often cosmetic, changing the number of shares but not real value. Still, they can help shareholders by offering flexibility and tax benefits, if done properly. The deeper message is clear: managers must act in the shareholders' interest. That means not just running operations well, but using capital wisely, either by investing efficiently or returning it to owners through dividends. Now ask yourself, if a company keeps your share of profits, do they use it to grow your wealth, or just to grow their power? Historically, there was tension between shareholders who wanted more cash and management who wanted to reinvest profits. Weak companies kept dividends low out of necessity, and the market often punished them. Strong companies used to pay out 60 to 75% of earnings. But times changed. By the 1960s and beyond, even profitable companies started paying lower dividends, claiming they could reinvest cash for better returns. Growth stocks like Texas Instruments rocketed in price without paying a cent in dividends. Investors accepted it, sometimes blindly. But Graham wasn't convinced. He believed shareholders should demand one of two things: a reasonable dividend payout, about 2/3 of earnings, or solid proof that retained earnings are producing better results. In cases where earnings are hoarded but growth is weak, low dividends often drag down stock prices, and shareholders should question or protest this policy. Chapter 20. Margin of safety as the central concept of investment. Benjamin Graham begins this chapter with a powerful idea. Just like ancient wisdom summarized life as, "This too shall pass," the ultimate rule of investing can be boiled down to 3 words: margin of safety. This principle isn't just a strategy, it's the entire foundation of sound investing. Whether you're buying bonds, stocks, or businesses, the margin of safety is your protective cushion, the difference between the price you pay and the intrinsic value you get. For example, Graham says a sound bond should be backed by earnings 5 times higher than its fixed charges. That way, if profits fall, the bondholder is still safe. This excess earning power is the margin of safety, and it exists so you don't have to perfectly predict the future. When it comes to stocks, Graham emphasizes buying well below estimated value, so if your projections are slightly off or the company stumbles, you're still protected. He uses the metaphor of an insurance policy. You hope you don't need it, but you'll be glad it's there when things go wrong. This principle is tightly linked to diversification. Even with a margin of safety, some picks might flop, but by spreading your investments, the overall gains should more than outweigh the occasional loss. That's how insurers make money, and that's how intelligent investors do it too. Graham contrasts 2 investing mindsets: the speculator, who bets on predictions and market timing; the investor, who relies on data, valuation, and a margin of safety. True investing, he says, means you don't rely on being right. You plan to be wrong sometimes and build your portfolio to survive it. He also warns against chasing popular stocks at high prices. Even the best company becomes a poor investment if the stock is too expensive. The margin of safety disappears the higher you bid. So ask yourself, are you buying with a cushion of safety beneath you, or are you jumping with no net? And that's a wrap, explorers. You've just completed the ultimate investing journey with the intelligent investor and me, Zuzu, the book reader. From market swings to margin of safety, you now carry timeless wisdom that can guide your financial future. If you found value in this video, hit that like, smash subscribe, and share it with someone ready to invest smarter, not riskier. Until next time, stay curious, stay disciplined, and always invest with a margin of safety.